The accounting cycle is a series of steps that businesses and organizations follow to record, analyze, and report their financial transaction. Here I will give you a simple but complete explanation of each step in the accounting cycle. Hi everyone, my name is Hanna Mardhiyah from Politeknik Negeri Batam, and this is my student ID number. So I will explain this cycle with this flowchart. And as we can see, the first cycle in accounting is identifying transaction. The cycle begins with identifying and collecting all financial transactions that have occurred during the specific period. These transactions can include sales, purchases, expenses, and more. Second, analyzing transaction. Once the transactions are identified, they are analyzed to determine their nature and effect of the financial statements. This involves categorizing transactions into accounts like assets, liabilities, revenue, and expenses. Third, journalizing transaction. In this step, each transaction is recorded in a journal or a general ledger. A journal entry typically includes the date, a description of the transaction, the account affected, and the dollar amounts involved. Fourth, posting to the ledger. The information from the journal entries is then transferred to the appropriate accounts in the general ledger. This process keeps a running balance for each account, providing an up-to-date snapshot of the financial position. Fifth, preparing a trial balance. A trial balance is a list of all ledger accounts balances to ensure that the debits and credits are equal. If they don't balance, it indicates an error that needs to be corrected. Sixth, adjusting entries. At the end of an accounting period, usually monthly or annually, businesses make adjusting entries to reflect accrued expenses, prepaid expenses, unearned revenue, and other adjustments. These entries ensure that financial statements are accurate and match the accrual basis of accounting. Seventh, preparing financial statements. With the adjusted balance, the next step is to create the financial statements, including the income statements, balance sheet, and statement of cash flows. These statements summarize the financial performance and position of the business. 8. Closing entries. To start the new accounting period with a clean slate, temporary accounts such as revenue and expenses accounts are closed by transferring their balances to the owner's equity or retained earnings account. This step resets these accounts for the next period. The accounting cycle repeats for each accounting period, providing a systematic and organized way to maintain accurate financial records and prepare financial reports. So that's all my presentation about accounting cycle, and thank you for listening and goodbye!